Traditionally, people like to say that the stock market isn't the economy. And while that may have been true in the past, there's now such a large concentration of wealth and spending in America that the two are more closely linked than ever. Let's take a look at how a cutback in spending from the highest earners could impact the economy and the stock market. First, let's look at this chart, which breaks down the stock and mutual fund ownership by income group. As we can see, over the last 20 years, the highest 1% of earners have seen their wealth from assets grow to about $18 trillion from the end of 2024, from about $4 trillion in 2004. For the bottom 60%, the total was less than $3 trillion last year. We can also see a similar trend play out in consumer spending. According to Moody's Analytics, the top 10% of the population accounts for half of the spending in the United States. This is up from 36% 3 decades ago. Consumers drive the economy. In fact, their spending made up about 68% of US GDP in the fourth quarter of 2024. So all of this tells us that the economy depends on the top earners to continue to spend more than ever before. But those top earners are also the ones who own the most financial assets, including stocks. And even in times of high inflation, the top 10% kept most of their savings, while most Americans reached into their savings to keep up with rising costs. Part of what keeps high earners spending is what's called the wealth effect, the idea that you feel richer when you see the value of your assets rise, even if your income and expenses remain the same. As a result, you splurge more, you take out loans against those assets, and in doing so, you fuel the economy. The problem now is that investors have been looking at the stock market and seeing the Nasdaq having fallen 20% from its peak, with the Magnificent Seven, a very popular trade, down even more. So now the wealth effect for top earners has taken a serious hit. And it could create a double whammy effect, where their wealth in their portfolio is down, so they spend less. And in turn, that hurts the economy, which hurts the stock market even more. So as an investor, how do you keep the temperature check on the wealth effect for top earners? One way is to keep an eye out for what CEOs are saying this earnings season. Walmart will report its first quarter earnings in May, and has said its sales are hinging on wealthier people. So that's one company to watch. Luxury brands like LVMH could also give hints on how this specific group of people is reacting to market volatility. Financial markets were on the brink of a liquidity crisis in early April. We didn't get there, but if top earners are spooked enough and their wealth feels threatened, investors should be prepared for a potential negative feedback loop.